Hi, I'm Karen Ward.
And I'm Hugh Gimber. Welcome to JP Morgan Asset Management's Markets Explained.
Your weekly briefing, where we cut through the noise and focus on what matters most for investors, setting you up for the week ahead. I should start by saying thank you to you, Hugh, for doing such a fabulous job the last couple of weeks with the guests that you had. In fact, the first thing I did to re-engage with what's been going on was listen to both those podcasts, and it did exactly what it was supposed to do, had me fully informed.
Well, that's good to hear. At least I guess if one of us listens rather than is here, we get an extra listener every week. So maybe a good way to hack the system.
Very good. Well, lots has gone on. The piece of news that I really didn't want when I was on holiday was the escalation of tensions once again in the Middle East. I mean, I guess as I was sat there processing that news, I came back to what to me has provided comfort through this whole period, which was about the incentives on both sides, that for the US, spiraling oil prices in the run-up to the November midterm elections would be in no interest of the president. On the Iranian side, to me, it's been more about the influence of China. And I believe we had some data last week, once again telling us that China's domestic economy is incredibly weak, is very reliant on exports, and therefore Iran, via higher oil prices, pushing the world economy into recession, was not going to do China any favors, and then China would certainly have words with Iran. So I've kind of taken that news flow. Maybe it was just me trying to reassure myself this shouldn't ruin my holiday, but does that seem a sort of fair characterization?
I think that's fair. What's been striking to me is how the equity market has been willing to look through the moves in oil prices themselves. So we had oil at one point back above $100 a barrel last week, and yet risk assets still were holding up pretty well. And then the second is the fact that we're coming into another week, another Monday, and there's no major progress in talks. All we've had is a couple of days where the strikes from both sides have eased off. And yet we have oil prices today back below $90 a barrel. I think before I left my desk, it was about 88. So this to me tells you that the market is looking as much as possible to say the incentives are there as we've described. And therefore, yes, in the short term, things have deteriorated over the past couple of weeks, but that negotiations are still expected to lead to some form of resolution that opens the strait after all.
Yeah, absolutely. And I think that's fair. I mean, the equity markets looked through it, but I guess once again, it's the bond market that's reacted a little bit more aggressively with the prospect of higher inflation leading to higher interest rates. And it's a really big week for central banks this week, isn't it? So we'll hear a lot more about how the central banks are planning to conduct their policy, whether they are worried about headline inflation rising and needing to anchor inflation expectations and needing to act, or whether they believe this will be transitory and look through. I mean, one thing I was surprised at, Hugh, which is quite rare, is when I sat down and looked at pricing, there's actually quite a lot of uncertainty about the Fed meeting, which is the first one up, isn't there, on Wednesday? So there's 10 basis points priced, which is quite unusual. Usually they try and make central bank telegraph what they're planning to do so it doesn't generate volatility, but there is 32% chance that they hike. How do you interpret that?
I think there's a lot of this is about the new era of Chairman Walsh, frankly, and we've heard from him and some of his colleagues over the past few weeks, and they've been striking a very clear tone to say we're not comfortable with inflation above target for an extended period. And obviously, the news flow over the past week has pointed towards more inflation pressure given the move in energy prices that we're seeing. But the key thing that Kevin Walsh is trying to change is to reduce the amount of communication. And therefore, if you're a bond investor going into this week's meeting, I think inevitably you have to price a little bit more risk of a change because you're just less sure. You know, a few months ago, Chairman Powell very much in that role, bringing the committee together and trying to form a coordinated and a single response. Now, if you're going to have more dissents across the FOMC, you have to go into every one of these meetings saying, well, look, the base case is that the Fed doesn't move, and I think that's correct. But you have to price just a bigger amount of chance that ultimately the Fed does surprise us.
Yeah, I mean, that's probably not great in terms of, therefore, news flow, volatility, because if they did hike on Wednesday, the market, I think, would probably think, my goodness, well, are they going to do several this? Does that concern me? I mean, I think, however, as we think about the Bank of England then on Thursday and central expectations from the Fed, we would expect them both to be on hold, but to be doing some pretty tough talking. I almost think that the more the central banks talk tough, the hope is that they don't actually then have to deliver. So there's very little expectation the bank will do anything on Thursday. Is that right?
That's right. Although when you look out towards the end of the year, both the Fed and the Bank of England are priced for more than one interest rate hike between now and then. So I suspect this Thursday will be less exciting than the Fed on Wednesday night, but still looking for any further clarity on how Andrew Bailey and his colleagues view the market pricing and whether or not they feel comfortable with further hikes already being assumed by the market, or maybe you go back to some of the language that we've heard more recently from the Bank of England saying actually maybe the market's a little ahead of itself in terms of how much they're going to have to do this year.
And I guess one of the big things the Bank of England are waiting on is exactly what fiscal policy is going to be doing, going on in the background. And we'll come back to that. But maybe before we do, it is probably worth us spending a bit of time on the Bank of Japan, because the Bank of Japan is very important for global interest rates. They may be far away, but this is the region, very large savings region. They've been providing very low interest funding for the global economy for quite some time. And there's some quite interesting, and I would argue some quite worrying things going on in the policy space there. I said to you when I got back this morning, I note that the 30-year in Japan is getting at really nerve-wracking levels, like what's going on. Can you just sort of fill us in on what's happening? And it's the combination, isn't it, of fiscal and monetary policy that's making the market nervous.
Definitely. It's the way in which those two work in tandem, which I think is the concern. Because as we know, Takaichi, the new prime minister, or relatively new prime minister in Japan, is keen to spend more on the economy, whether that's on defense spending or more domestic subsidies, very much viewing fiscal policy as a tool that Takaichi wants to use more frequently. And over the past couple of weeks, we had a new growth plan from the Japanese government where they said, we would like the Bank of Japan to work in tandem with us to help us achieve our growth goals. And that for the bond market, as we know anywhere, is a big worry, because what you don't want to see as a bond investor is a central bank which is being told what to do by the government. You want them to be independent and reacting to the inflation pressures that they see in the economy. So on the back of that, we had a big move higher in Japanese bond yields, particularly at the long end of the curve. Since then, the government has had to take steps to try and walk that back. And unsurprisingly, we've heard language about how valuable the Bank of Japan's independence is. We've also had some encouragement for domestic investors to be putting more money to work in Japanese bonds and equities. So I think this is almost the bond market just tapping the Japanese government on the shoulder to say, yes, we know you want to spend more money. We know this is potentially good for growth, but you have to do this in a way which is tolerable for bond investors.
Yeah, I mean, I hope that is a bit of a lesson to policymakers closer to home. So coming back here in the UK, we've now got Andy Burnham, of course, Prime Minister, thoroughly in seat, albeit one in the north rather than necessarily close to us here in London. He's come up with some immediate announcements, hasn't he, on cost of living. That's going to be helpful for bringing down headline inflation. So he's actually helping out the Bank of England a little bit there. I guess as I think about the rest of the year, I'm sort of asking myself, when we think about, is this going to be good for reviving growth? Well, first of all, is he going to really, in a very upfront manner, talk about how he's going to free up space for more spending, whether that's on council housing or other infrastructure projects? And, he is talking about needing to get the benefit system under control, and perhaps that might be his way of creating that space to spend and actually have some impact. That could, I think, be very growth positive, as long as it's done in a sensitive way for those individuals that are affected. What I don't want to see is lots of talk about spending ambitions and things that want to get done with no clear direction on how they will be funded, because otherwise we're going to be stuck in this quagmire that we have been stuck in of constant speculation about what taxes are going up in the autumn. And that has just been absolutely stifling for economic growth here, hasn't it, these last couple of years? Of just this constant, every sector anticipating what taxes are going to impact them. And so businesses around the country being in wait and see mode. So although we probably need to wait to the budget to have clear direction, I almost in many ways hope that a vision is set out now or as early as possible.
I think that's where the choice of Chancellor is an interesting one, because obviously Chancellor Healey did resign in the previous government because he was a very vocal advocate for more defence spending. And effectively, the question that he's being set now is, well, okay, you want to spend more on defence, you can spend more on defence, but you've got to find where in the budget that money can come from. So worth noting, just last week, the gilt market, the UK asset markets generally were very well behaved. Yes, yields were on the up, but I think that was more to do with what was happening in oil prices and inflation concerns globally. Relative to the US, relative to Germany, UK bonds were well behaved, and similarly the pound was trading pretty well. So I think it's been a positive week one, certainly not a major market scare straight away, but I couldn't agree more with you that the challenge here for the government is to buy themselves time to get to that autumn budget with a fully scoped out plan, but without leaving too much room for speculation in the meantime that just forces businesses back into what they were doing last summer, where the response was very clear. If we don't know what the rules of the game are, we're simply not going to play. We're not going to spend, we're not going to hire. And we saw that come through very clearly in the UK data last summer.
Yeah, absolutely. And it's still the case. I mean, the labour market data, I was just putting together my answer for the shadow MPC that the Times publish. And, my answer was all about the big problem here in the UK is our labour market's completely stagnant. And therefore, that's the reason why inflation's unlikely to get embedded and the Bank of England shouldn't be raising rates. Okay, let's round out then, Hugh, with what we're learning from the US earnings season. And, when I left, perhaps in anticipation of holiday, I was talking a lot about pies. And the reason for that was because the big question for me as we go through not just this earnings season, but the remainder of the year is all about navigating tech. It's such a massive part of the US index. And we're moving from the point of the creation of the technology to the adoption of the technology. So this is where the questions really come to the forefront. And the reason the pie is the analogy is because ultimately the $1 trillion question is how much is AI going to boost productivity, profitability, and nominal GDP? That's going to generate the return on investment for the tech sector and the earnings which would justify their valuations. So that's probably the big question, which we're still waiting for the answer on. We may have to wait quarters and years even to get a full answer for that. But in the interim, there's this other question going on about how within the tech sector, they're each eating their own slice of the pie, aren't they? Particularly between the semiconductors and then the hyperscalers who are using all of those chips to produce the technology. So what have we learned and what have we got coming up that might give us a little bit more information there?
Sure. So in terms of what we've learned so far, the results have generally been very positive. What's been unusual about this earnings season is that expectations were on the rise coming into reports, and they've still been beaten. So the banks got us off to a good start a couple of weeks ago. Last week, we had more good numbers from Alphabet and from Tesla, but the market response to those hyperscaler earnings has so far been pretty negative, with both of those companies turning cash flow negative. In other words, CapEx now is absorbing all and more of the cash that those companies are raising. This week is a big week. It's arguably the busiest week of the season. We have 177 names in the S&P 500 reporting. And the 4 tech giants that are coming up are Microsoft and Meta on Wednesday, and then Apple and Amazon on Thursday. So a really big week in learning more about the commitment that these hyperscalers have, not just to their previous announcements on CapEx, but being willing to go further again. Finally, just note that elsewhere within tech, semiconductors seem to finally starting to be showing some signs of settling down. So a better week for semis, perhaps because they are the recipients of that hyperscaler CapEx. And so even if there's a big question on the return on that investment for the spenders, the recipients of that spend are clearly benefiting in terms of higher earnings to come.
So just to be clear, what's going on at the moment in the market narrative is the semiconductors are grabbing a bigger slice of their pie by charging the hyperscalers bigger prices. So what we're looking for is, do those hyperscalers start to say, this is getting too much, like this cost of production of the technology is getting too much? Do they start to scale back? Because would this be the first time, would I be right in thinking that the trend up until now has always been to be raising CapEx plans? So even holding firm would maybe be a little bit add nerves to the market that questions of overcapacity are starting to be reached.
I think that's absolutely fair. And what we're also seeing is that in those areas of bottlenecks, so like memory, you have new entrants on the way as well. Just this morning, we've had an IPO in China, which is up a cool 470% on the day. China's just 470% so far. And this is now China's biggest stock, and it is a memory maker. Wow. So no wonder that these healthy margins and real capacity constraints are bringing new entrants, which is part of the concern that the market's having around some of the winners in memory so far, just understanding that these types of supply bottlenecks don't tend to last permanently.
The lure of hypernormal profits. Okay, so we got a busy week ahead. I'm then disappearing off again for another week. I'm loading all of my holiday into this nice quiet period. I'm off on my silent retreat. So for those of you who know me, you'll be baffled by the idea that I can be silent for an entire week. But anyway, I shall come back refreshed, full of new ideas.
Full of talking, I imagine, a week on Monday.
And even more talking. The look of horror, I can tell you, in Hugh's eyes right now is something to behold. But you've got Ian Steely, which I think is going to be great next week on the pod to talk through what we've learned from the central banks.
Big time, yeah. Lots to get into on the central banks. And also, I think the bond investor perspective on some of these hyperscalers will be worth some time as well.
Good. Okay. Well, for those of you out there also heading off on holidays, wishing you lovely and safe travels. Do keep listening to us. We'll keep you informed, this bite-sized snippet of what you need to know. And as we've said before, we really appreciate any sharing, any subscription. It definitely helps us out in order to keep the funding going, to keep it going. So yeah, much appreciated and wishing you a good week.
This communication is educational in nature and not designed to be taken as advice or a recommendation to buy or sell any investment or interest thereto. It is based on assumptions in current market conditions and are subject to change. It should be noted that the value of investments and the income from them may fluctuate in accordance with market conditions, and investors may not get back the full amount invested. Past performance, yield, or forecasts are not a reliable indicator of current and future results. JP Morgan Asset Management is the asset management business of JP Morgan Chase & Company and its affiliates worldwide.